Hey everybody, and welcome to my next installment of my live option trading series. My name is Scott Reese, and I'm here to help you learn how to trade, invest, and master your finances so you can apply that knowledge in the real world and multiply your money. And so every Friday, I post a video just like this, which again is part of my live trading series. And in this video, I'll talk about all the trades and all the adjustments I made this past week. And so specifically in this video, there's definitely a lot to talk about given what happened in the market this week, especially with tech stocks, as you can see here with the QQQ ETF. So I'll definitely be talking about that, and then also what's happening with interest rates and inflation. And then in terms of my actual trading this week, I'm going to show you a few adjustments I made with a few of my positions, one of which is a more different kind of adjustment than I normally do, and I think you'll find it to be very interesting. And then also, I did just put on a new trade in Nvidia, and I'll show you that at the very end as well. Now, as always, before we dive in here, in case you are brand new to the channel, I just want to let you know that you can also find me on Skillshare as well, where you can take my very in-depth classes on options trading or stock market investing. And I provided some links to some of the introductory courses of mine in the description of this video below. So be sure to check them out. And when you sign up for Skillshare using any of those links, you'll get a full 1-month free trial. Okay, so first off here, let's talk about what exactly happened in the market this week. So again, I'm showing you in this chart here, QQQ, which is an ETF that tracks the NASDAQ, and I'll zoom in a little bit. So as you can see this past week and also in recent weeks, the NASDAQ as a whole and also other indexes as well have been undergoing a pretty major sell-off. And even though, like I mentioned, other indexes are going down as well, the S&P 500, the Dow Jones, Russell 2000, etc., all stocks are pretty much sliding this past week, but it's especially bad for tech stocks here. And in fact, from high down to the low, the NASDAQ so far has gone down by over 13%. So that is technically an actual correction that we are seeing here. Right, I believe a sell-off of more than 10% is an actual correction, and then more than 20%, that is considered to be an actual bear market. I'm not sure who made up those rules, but that's just the way it is. And then, of course, as a result of all this selling chaos, as you might expect, if we go to the VIX futures chart now, /VX, the VIX is pretty much exploding this week, all the way up to a high so far of around 26, almost 27%. So in case you're not aware, the VIX futures that you're seeing here, they will show you the implied volatility for the S&P 500. And this is basically my main indicator to see how much fear there is in the market right now, right? So when implied volatility explodes like this often happens during a major market sell-off or a correction. And hopefully that should be a bit intuitive. When stocks go down in a big way, people tend to get very fearful. And of the many ways to interpret implied volatility, one such way is that it's a measurement of fear in the market. And the main takeaway from something like this is that when the VIX explodes, you will see the prices of option contracts across the market, because again, the S&P 500 is pretty much the bulk of the market. You will see option prices increase drastically as well. So that's why, of course, if you were lucky enough to buy put options before all this chaos happened, then not only did you get the directional move correct, right, stocks moving down, but you're also getting a very nice implied volatility expansion. And that's also going to increase the prices of the put options you may have purchased. And then, of course, if you're like myself and you like to sell options as opening trades, then this is going to hurt your existing positions, right? When you sell options, you always want the prices of those options to decrease in value. So basically, in that case, you would actually want implied volatility to contract, which does happen the majority of the time. That's one of the main reasons why I'm always on the selling side of options. But when the few times occur where implied volatility explodes like this, then again, that's going to increase the value of the options you sold, and that's going to hurt you at least for the time being. And so whenever the selling does come to an end, and I would not be surprised if next week, for example, we saw a bit of a relief rally, when that happens, I do expect to see implied volatility here come down significantly, just like it has every single time in the past. But one final thing I want to mention here in regards to implied volatility. Yes, a spike in the IV across the market will hurt your existing positions, but this is a great opportunity to put on new positions, right? Because at the moment, option prices are very high. So if you're an option seller, again, it's going to be a great opportunity to step in and sell those very expensive options. And this here is exactly why I put on a new trade in Nvidia, and also why I took off an existing position to make room for that new trade in Nvidia. And so then now in regards to inflation, and this is one of the prevailing theories as to why tech stocks are being hammered so much recently, if we now come over to TBT, this is an ETF which basically tracks interest rates, specifically on US Treasuries. So if we zoom in here, as you can see clearly in the past couple of weeks and also the better part of 2 months, interest rates have been climbing pretty steadily. And this, in my opinion, is definitely an effect of one, the Fed saying that they are going to raise rates multiple times this year in 2022. And then also the bond market as a whole, independent of the Fed, is saying that interest rates do also have to climb higher to compensate for inflation, obviously. And basically all the trillions and trillions of dollars, thanks to the Fed, of course, that have been pumped into the economy, both in the US and also globally as well. Now, as for the exact reason why increasing interest rates are bad for tech stocks, there are many opinions. My personal opinion is twofold. Number one, tech stocks are by far the most overvalued asset class than any other class, right? For example, if we go back to QQQ real quick, and we'll change the time frame on this chart. Let's go to a 3-year weekly chart and just take a look at how explosive the NASDAQ has been since the bottom or the actual crash of COVID in 2020, right? Tech stocks in particular have gone up faster and higher than, as I said, any other asset class. And at some point, and I've been saying this multiple times, at some point, all of this has to come to an end. Stocks do not just go up in a straight line forever. Yes, perhaps in the very long term, stocks do climb higher. That's definitely a fact. But as I said, since the bottom of the COVID crash of 2020, and since the beginning of all those trillions of dollars that the Fed has printed and injected into the economy, the NASDAQ has done one thing, gone straight up. And now for the first time in about 2 years, we're finally seeing the NASDAQ break down below the 20-period moving average, which you can see here in blue. So again, because in my opinion, tech stocks here are definitely the most overvalued asset class. And generally speaking, when interest rates increase, that's generally bad for stocks in general. The reason being is when interest rates increase, money becomes more difficult or more costly to borrow. So that definitely puts a damper on growth. And then also with increasing rates, that entices investors to take money out of stocks, which are more risky, of course, and park some of that cash into bonds or treasuries and basically make some return, a small return, but a very safe return. So basically the point I'm making here is if there's any asset class that people are going to take their money out of first, it's probably going to be tech stocks. Right, these stocks in particular have had a massive run over the past 2 years, and in my opinion, at some point in the near future, and perhaps it's actually happening now, it's going to have to come down in a significant way. So I'm not in the business of trying to call tops here. Who knows, maybe in 1 or 2 weeks, we could be back at all-time highs again, but at some point, I do think we're going to see a more long-term downtrend with tech stocks in particular. And so with that being said, I just wanted to give you guys a brief market analysis in this video and also share some of my thoughts and opinions on this stuff. But now at this point, I'm going to stop here and play a few clips that I recorded from this past week that will show you some of those adjustments I made in my Roblox and SE positions. Okay, today is Tuesday, January 18th, and a few updates I want to give you in this clip here. Number one, with C Limited, this is SE. I do have a short strangle on the stock, so if we come to the trade tab very briefly here, originally with this position, I was short the 240 strike call option along with the 175 strike put option. But now as you can see here with the call option, I've actually moved down my call to the 195 strike. This is basically rolling down the call option. And the reason why I did this is to take in additional credit for my entire position. So by basically buying back the 240 strike call and then selling the 195, the additional premium I took in was about $470. And basically I made the decision to do this because this morning, unfortunately, SE had a very bad gap move over my put strike, and that caused me to lose a lot of money. So briefly, in case you're not aware, every time I have a short put option like this, whether it's a short put by itself or it's in a short strangle, every time the stock falls below my put strike, at that point I will short 100 shares of the stock. So in this case, with this 175 strike put option, if SE falls below 175, I do have automatic orders in place that again will short 100 shares of the stock. And as I was saying, this morning SE did have a very bad gap move over my strike. It basically opened at around $171 per share, so I still shorted the shares anyway to cover my put contract, but then the stock came all the way back, went above 175, and at that point, once the stock recovers above my put strike, I'll buy the shares back and take my losses from doing that. Now, normally those losses are usually about $50 or $70, but again, if there's a big overnight gap move, then chances are if the stock reverses, I'm going to lose a lot more money. So again, that's why to compensate for those losses, that's why I rolled down my call option and took in an additional 400 plus bucks in premium. So that basically totally cancels out the losses I took from that big gap move this morning. Now that being said, of course, I now have a much more narrow short strangle. So if this stock reverses really hard and if it goes above 195, my new call strike, then at that point, I'm going to have to buy 100 shares of stock to cover this call option here. So anyways, that's the one adjustment I made with SE today. And then also in Roblox, very similar story. Let's go to the option chain for this stock. So this position started out as simply a short naked put option at the 80 strike. But again, unfortunately, in a very similar fashion with SE, this stock was actually bouncing through my put strike many times today. So again, if the stock falls below 80, I'll short the stock. And if it recovers back above 80, I'll buy them back for a small loss. And as I was saying, that happened a few more times than I would like today. So again, that's why I made an adjustment to take in additional premium. Now, instead of rolling down a call option, I simply had no call option with this trade, right? As I said, this one started out as simply a naked put option. So to make an adjustment, I simply sold the call option. That was it. And so as you can see here, I sold the 105 strike call option. And when I did so, this was about 205 bucks or so. So that means I've already made a little bit of money on this call option because the final time Roblox did fall below 80, it has continued to go lower ever since. And as you can see up here, the stock did close today at around 77 bucks per share. And so those were the two updates I wanted to provide you with in this clip here. Obviously, it's not ideal to have to make adjustments when you're losing money on a position, but it's certainly a very necessary part of trading, right? Of course, not every single day you're going to be either making money or just kind of going through the motions of things. Sometimes it's going to get a bit hairy and you're going to have to get into your platform and start making adjustments and trying to save your trades. So that's it for this clip, and I'll see you in the next one. All right, it is now Thursday, January 20th, and just one update I want to give you in this clip here. So today I did make a more different kind of adjustment in my Roblox trade. So let's go to the trade tab briefly, and I'll show you what I did. Again, for this position, I'm in the February expiration cycle, 29 days left to go. So as you saw in the previous clip, I made an adjustment where I sold the 105 strike call option to take in additional premium for this position. And again, this trade started out as simply a short naked put option at the 80 strike. But as I explained, with Roblox bouncing through my put strike many times, I had no choice but to sell this call option over here to again take in that additional premium. Now, normally what I do with these kinds of adjustments is I will either hold it all the way to the expiration date or until I can exit the position for a profit, or I might actually roll down the call further to take in even more premium if I need to do so. That being said, as you can no longer see here, there's no longer a position flag like you can see with the put option. So that means today I actually just took off my call option and I did so for a nice little profit. So basically yesterday I sold this call option for about 220 bucks in credit. And today, not too long ago, I bought it back for a debit of about 100 bucks. So that means I actually realized a profit of $120. Now that also means, of course, that I did miss out on keeping that remaining 100 bucks in the call option here, but I did that for a reason. So specifically, as you can see right now with Roblox closing today at 75 bucks per share, which is pretty far below my 80 strike put option. So that means, again, right now I'm short 100 shares of the stock. And if Roblox never recovers, if it never recovers back above my put strike, that is, then by the expiration date in 29 days, the final outcome of this trade would still be a loss, but only about 70 or 80 bucks or so, pretty small. And again, the reason why at the moment, the final outcome of this trade, should Roblox never recover, the reason why it would be a loss is because, again, I bought back this call option before I kept the entire 220 bucks of premium. Otherwise, then this trade would be slightly profitable by the February expiration date. Now, my thought process behind doing this, the reason why I took off my call option early, is because should Roblox actually recover at some point, right? Which I think is decently likely given that there's still a full month left to go to the expiration date, is let's say Roblox recovers above 80 or perhaps a bit higher than that, then I have the chance at that point to sell the exact same 105 strike call option or perhaps something similar to it for another round of 220 bucks or perhaps a similar amount in additional premium. And the reason why I actually might be able to do that is because, of course, in the case where Roblox does recover, then this 105 strike call option is going to increase in value again. Right now, it's only about $100 because Roblox has sold off pretty significantly. But if the stock returns to $80 per share or $85 per share, then I will guarantee you that this call option is going to be worth maybe $200 or $300. Assuming, of course, that Roblox does recover, assuming it does, in the relatively near future, maybe the next few days or the next week or so. That's the main caveat to doing this, right? But if instead Roblox takes, 3 weeks to recover back above 80 or to 85, then even that directional move higher is not going to move the price of this 105 strike call option that much, right? And that's because, time decay and perhaps some implied volatility contraction, those two things are going to continue to eat away at the value of this call option. And again, perhaps the directional move higher, if it takes too long, will not be able to compensate for that. So of course, there definitely is some risk to making this kind of adjustment, but as I said earlier, if Roblox never recovers, then the final outcome of this trade will be a loss of only about $75 or so. That's a pretty small, manageable number that I can deal with. But if it does recover sometime in the relatively near future, then again, I might be able to sell this 105 strike call option all over again for another fresh round of $200 or $300 in premium. So this is basically an alternative way to take in additional premium on your trade without actually rolling down the call option. And you definitely can do that. That's what I did with my SE position, as you saw in the previous clip. But I do want to be careful about rolling down my options too quickly. And that's because, of course, once I roll this down to perhaps a straddle or somewhere close to that, then I'm totally out of adjustments. And I'm basically at that point at the mercy of what the stock does for the remainder of the expiration cycle. So basically, I'm just trying to pace myself with the adjustments I'm making, and I'm trying to find different ways of taking in additional premium on my positions. And as I just showed you with this new kind of adjustment, I've already realized an additional profit of $120. So again, if I have the chance to sell the same call option again for another round of perhaps $200 in premium, that would bring the total additional credit to over $300. And of course, the main benefit is I would still have a pretty wide short strangle on here. So again, that's opposed to instead rolling down the call option and giving myself a very narrow strangle, and therefore increasing the chance that if Roblox does recover, it could blow through my put strike and my call strike, and I could lose a lot more money if that happens. So anyways, I just wanted to show you that new kind of adjustment that I've been experimenting with on Roblox here. I'll probably test it out on a few more positions as time passes, but I do think this might be a nice addition to my set of trading mechanics. So definitely for any of you who are trading strangles or naked puts or calls like me, regardless of whether you are using stock hedging or whatnot to manage your trades, still keep this kind of adjustment in mind as well. Okay, welcome back. I hope you enjoyed those few clips there. And so now finally in this video, I do want to touch on a few more things. So first up, in Roku, I do have a position on this stock, which is expiring today. So we'll come to the trade tab. And again, January expiration cycle. Today is expiration day. So for this trade, when I first put it on, I initially sold the 197.5 strike put option, which I still have on, and then also the 247.5 strike call option. But this one here, I actually bought back for about a $10 debit, I believe last week, and now I just have the remaining put option. But initially, this was a short strangle, and pretty much immediately after I put this one on, Roku went against me in a huge way. So this stock dropped pretty hard, and then it bounced through my put strike so many times that I couldn't even count. Right, there was definitely one nasty day in particular where Roku was simply pegged right at exactly 197.5, and so I did lose a fair amount of money from having to repeatedly short and buy back the stock again and again and again. But fortunately, after that day passed, Roku simply kept on sliding and kept going down, 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 and now it's sitting at about $156 per share, which is over $40 below my initial put strike. Now briefly, if we bring up the calculator real quick here, initially I sold that strangle for $740 as a credit. Now if I did nothing to defend this position, and if I were to take assignment today once the market closes, I then would be forced to buy 100 shares at a price of $197.50, and if I did not want to keep those shares, which I personally would not, then I would have no choice but to sell them at the market price of only $156. So basically that would be a loss of over $4,000, but just to make the math easy, we'll say exactly $4,000. So essentially, with no defense on this trade, I would be looking at a loss of over $3,300 or so. Now, of course, Roku could recover a bit between now and the actual closing of today's market, but let's just say if right now everything expired exactly where it is currently, then yes, I'd be looking at a loss of about 3,300 bucks. But fortunately, however, the final time that Roku did fall below my put strike here, of course, I shorted the stock once again. And now with the stock having simply gone lower and lower and lower each week, I'm now totally covered on this position. So basically, if we do the exact math to figure out the final outcome of this trade now, let me go ahead and clear the screen. My total remaining net credit on this trade is minus $276.89. So again, I do not have a positive net credit on this position because Roku, as I explained, was bouncing through my put strike so many times on one day that I simply lost too much money. And this number here was actually after I made some adjustments to the trade as well. Specifically adjustments to take in additional premium on top of the 740 I collected when I first put on the trade. So now keep this number in mind because it's going to come into play at the very end of my calculations here, but I'll go ahead and clear the screen. So like I explained, the last time that Roku fell down below my put strike, I once again shorted 100 shares of the stock, and the price I got filled at was $196.92. So pretty darn close to my actual put strike here. So now once the market closes, and I will very likely get assigned on this put contract, I will have to buy back those shares at my strike price. So now I subtract from this $197.50, and so therefore I'm looking at a loss of only 58 cents per share times 100 shares. That's only a loss of $58, not $4,000. And then finally we tack onto this the remaining net credit I have on the trade, which as I said was minus $276.89, and therefore the final outcome of this trade is going to be a loss of about $335. So still a loss, of course. I'm definitely not happy about that, but I'm definitely happy it's not a loss of over $3,300, right? I basically cut my losses here by a factor of 10. So just wanted to show you that very quickly here so you can see exactly how either shorting the stock or buying the stock to cover one of the contracts you have that goes in the money can be very effective to eliminating some pretty massive losses. And then finally in this video, I do want to show you briefly the new trade I made in Nvidia. So let's go to the charts there, NVDA. So earlier this morning, if I zoom in here a bit, the stock was down pretty hard all the way down to about 232 bucks per share. And so it was roughly around that point, maybe around 235 bucks per share, where I stepped in and sold a naked put option. So in particular, if we come back to the trade tab, for this trade, I'm in the February expiration cycle. And as you can see there, I sold the 220 strike put option. And at the time I did so for about 810 bucks in credit. So far this trade is looking pretty good. I've already made about 40 or 50 bucks or so. Can't complain about that. And again, the main reason why I wanted to do that, if we come back to the charts one more time, is mostly due to the implied volatility expansion that we're seeing this past week and in particular today. So the IV for Nvidia and especially tech stocks in general has spiked drastically. And right now we're seeing an IV rank of 85% and an IV percentile of 98%. So basically right now, the current IV for Nvidia is is very near the highest level it's ever been in the past year. And so that combined with many days of selling in a row, I did want to play for a short-term bounce here, right? Because even though, as I explained earlier in this video, I personally do think tech stocks are due for a more long-term correction, but I also don't expect them to go straight down either. Right, even in some very nasty bear markets, you'll still see some very strong rallies that might last for a week or more. And so again, that's kind of what I'm playing for with Nvidia and tech stocks in general right now. And so with that being said, that's going to conclude this video. I hope you enjoyed it. And please let me know your thoughts or if you have questions in the comment section below. And don't forget, if you want to take some very in-depth classes on options trading or stock market investing, then check out my Skillshare courses. Links in the description of this video. And finally, if you enjoyed this video, then please give it a thumbs up, drop a comment, and subscribe to my YouTube channel. I drop new videos every single week, and you don't want to miss out. So thanks again for watching, and I'll see you next time.